Wall Street enters a week of reckoning, Indian banking's revolution, and the FedEx debate. This is Vinay Uttam, your resident stock doctor, and welcome to a brand new episode of the Stock Doctor podcast. We're back to our usual time of Tuesday at midday, and by the looks of it, markets seem to be going in one direction as well. At least the US markets are. Yet another week in the green for US markets as they posted their best week since early August. By the way, you will notice a change of my tone, change in my voice. I'm not 100% fit, but I'm fit enough to actually get the get the show recorded. Have a great time with you guys. So yeah, just noticing apologies in advance if my voice is breaking or if my voice is a little different from last time. England, the winter is here already. At least the fall is getting colder and colder, and looks like my throat is finally starting to realize that. Anyway, yet coming back to the markets, coming back to the show, yet another week, like I said, in the green for US markets, they posted their best week since early August, with the Dow closing 47,000 for the first time as a combination of positive trade talks involving US and China, solid earnings numbers in Q3, and the much anticipated September inflation report coming in softer than expected, all contributing to the persistent bullishness on Wall Street. Once the dust had settled, all three indices firmly ended in the green, with the Dow jumping 2.2%, S&P 500 adding 1.9%, and the tech-heavy Nasdaq surging 2.3%. So, without further ado, I'm going to quickly welcome you to the Doctor's Weekly Snapshot. Lots to take you through, and I'm going to explain also in a bit what I mean by the week of reckoning, because it is one of the most crucial weeks. The current week is one of the most crucial weeks as far as I'm concerned, as far as the US markets are concerned, as far as any US investor is concerned. More on that in a minute. Let me first take you through the key developments of the week. First things first, the only key economic data from the government. So the only key government economic data for September as we approach day 28 of the government shutdown. So there was only one, and thankfully, it was one of the most important data points for both the investors and the Fed. I'm, of course, talking about the September CPI data or the September inflation data. Now, the good news is that inflation came in softer than expected. Bad news, inflation was on the rise again and continued to remain further away from the Fed's 2% target. So it was like, you can take it glass half full. You can take it however you want. On one hand, you have inflation coming in softer than what economists predicted. Second, you're not seeing inflation going down. It's continuing to go up, and it is moving further away from the Fed's set 2% target. Now, more specifically, in September 2025, annual inflation rate rose to 3%, up from 2.9% in August. That's what I meant by inflation keeps going up, but below the 3.1% forecast by economists. That's what I meant by coming in softer than expected. Core inflation, which excludes food and energy, also stood at 3%, indicating persistent price pressures. The main culprits behind the marginal increase were the higher energy prices. While President Trump's tariffs have not caused the kind of severe impact that many economists and investors were bracing for, there was still evidence of tariff-driven price increases. And this was evident by the increases seen in tariff-sensitive goods like apparel and sporting goods. All said and done, given that inflation came in below expectations, should be enough. I use the word should because you never know what the Fed is thinking. Like I said, there's no data for the Fed to depend on these days. The only government economic data was September inflation, and that's it. But all I'm saying is, given that inflation came in below expectations, given that things are not as bad as feared, should be enough for the Fed to cut a further 25 basis point at its meeting, scheduled for when? Scheduled for today and tomorrow. Actually, tomorrow you will get to know what the Fed decision is, so don't have to wait for long. And as you can see, the week of reckoning is slowly shaping up why it is. More on that in a bit. Now, despite the relief about softer inflation and how it should motivate the Fed to cut rates, consumer sentiment surrounding inflation remains weak. And why wouldn't it? Because prices seem to going up. I don't like it. You don't like it. Why should US consumers not like it? More specifically, why should US consumers like it? More specifically, US consumers continue to feel the pinch, especially middle and working class households, as wage growth has slowed and prices for essentials like food, housing, and utilities remain high. Surveys by Wall Street Journal show that a majority of Americans feel worse off financially than a year ago, and they do expect their incomes will not keep up with inflation. The impact is most severe for lower income households who spend a larger share of their income on necessities. Food costs have gone up faster than overall inflation. Last time I checked, food cost belongs to the necessities bucket. And so obviously most severe for lower income households, it cannot come as a surprise. And the lower income households have actually seen their wage growth lag behind inflation. So again, it doesn't really help things for the US consumer. There's one thing what the economic data suggests, completely different what's the ground reality. Yeah. So I want you to keep that in mind. Even as an investor, like, numbers might be all hunky-dory, but ground reality could be a whole. This is why sentiment surveys, I'm a huge fan of these sentiment. Now, of course, surveys are biased and all of that. They have their own negativities such as bias and so on. But I do think that investors need to put it together in order to come up with a more clearer picture of the US economy. And with the government shutdown leading to many government workers missing their paychecks, and given that should the shutdown continue, we will not get an October inflation report. This has already been announced that if it is very unlikely that October CPI report will be available. Forget PPI and all of that. The uncertainty surrounding inflation, along with the frustration of the US consumer, are two key developments that need to be accounted for and need to be constantly monitored by investors. For now, markets seem to be focusing on the glass half full, which is the connection between the Fed and inflation, as in softer inflation means another 25 basis point rate cut. But given that there won't be any data in October, the story could look shockingly different in the November report, a factor that investors, in my opinion, should certainly account for, or a risk that investors should certainly account for. There's also some positive news on the US-China trade front. Although the situation between the two countries is so fickle, so fluid, that one can't really say with any confidence how soon that good will turn into bad. You got it's a roller coaster. It's one of those roller coasters that just there's no like go up and then no, it's just up and down, up and down, up and down. So it's so volatile as things stand. Volatility, name of the game. That was the theme for last week's episode. For now, the good part surrounding US-China trade tensions, trade situation, was post the high-level trade talks in Malaysia between US Treasury Secretary Scott Bessent and senior Chinese regulators. Both sides claimed constructive progress. Story we've heard before, yes, but for now, it is a positive, positive development. Both sides claimed constructive progress, reaching preliminary consensus on complex trade issues, including export controls, rare earths, fentanyl precursor chemicals, agricultural trade, and the future of TikTok. China signaled willingness to delay its threat to restrict rare earth exports for a year, easing immediate tension. Keep in mind that President Trump and President Xi are expected to meet later this week. So while investors can take some positives from the progress made over the weekend, in my view, until I see an actual trade deal that is signed by both parties, acknowledged by both presidents in public, I wouldn't be investing solely on progress. The recent history between the two nations and the more confrontational stance adopted by President Xi this time around compared to Trump 1.0 was Trump 1.0 suggests that the situation continues to remain very, very fluid. If talks go well on Thursday, markets would certainly rejoice, but I wouldn't read too much into the situation until and unless a comprehensive trade deal is approved and, more importantly, signed. As they say, sign, seal, deliver. We are way off from that, in my opinion. Expect the situation to continue to remain fluid. I mean, the best I think the markets are hoping for is status quo, which is just, things are just great and that's it, and we'll continue talking, and that's that. And I guess for the markets that should be enough, but I wouldn't make like long-term bets or long-term predictions based on a couple of statements by either presidents. Anyway, switching our attention to the earnings season. The earnings season has been off to a great start. Q3 earnings season has been off to a very strong start. And given that key economic data is missing, investors at least have the earnings data to play with. Positive reports from the likes of Ford, General Dynamics, Coca-Cola, 3M, and General Motors all helped markets last week to climb to record highs. About 86% of the 130 S&P 500 companies reporting so far have exceeded analyst expectations. Private data and state-level reports have also suggested that there has been no recent surge in layoffs. In other words, earnings so far have reassured markets that core corporate health remains solid despite broader macroeconomic and geopolitical tensions. Looking ahead, now here comes the main part, why I call it the week of reckoning. Looking ahead, this week to me, is one of the most crucial weeks of the year for investors. A lot of crucial moments are set to appear, including the mega showdown between President Trump and President Xi in South Korea, the Fed's decision post its October meeting scheduled for tomorrow, and perhaps most importantly, Q3 earnings from 5 of the Mag 7 names. Personally, tomorrow and Thursday, Wednesday and Thursday are to me the days of reckoning in the week of reckoning as we get the Fed decision tomorrow, along with the earnings from Microsoft, Alphabet, and Meta, all at the same time, by the way. So expect a flurry of stock market activity tomorrow, post-market close. And then on Thursday, the outcome of the Trump-Xi talks, as well as earnings from Amazon and Apple. I don't think throughout the year we've had so much riding on just 2 days of a trading week. Wednesday and Thursday will determine if the horror will be limited to Halloween alone, which is taking place this Friday. Happy Halloween in advance. Or if horror is going to be the theme the rest of the year. On that note, I'm going to take you straight to India from the US. As, all the best with the week of reckoning. Talk more about it next week. Now we head to India. In our next segment, Doctor Goes Home. Now, I want to talk about a sector with you guys today that I haven't spoken for a while. Okay, the Indian India's within the Indian market space, and that's because I think this particular sector, as far from an Indian market's perspective, is certainly showing an inflection. Is certainly showing as if it's reached an inflection point when it comes to foreign investments. Yeah, I'm not going to keep you guys in suspense for long. I'm obviously talking about the banking sector, the Indian banking sector, which has seen a surge in interest from major global players. Now, let me give you some context on this. There have been 4 major deals announced so far. You have the deal where Japanese giant Sumitomo Mitsui Banking Group, SMBC, acquired a 20% stake in Yes Bank for $1.6 billion. The stake has now been raised to 24.99%. So they acquired an additional 4.99% stake. You then had Dubai-based Emirates NBD taking a 60% stake in RBL Bank for $3 billion. Finally, you had the global asset manager behemoth Blackstone, which is now set to become the largest shareholder of Federal Bank, a bank that has a very special place in my heart since my mom worked there for about 38 years. So very special place Federal Bank will always have. So Blackstone is now become this largest shareholder of Federal Bank is set to become the largest shareholder of Federal Bank post pending regulatory approval, after announcing that it would be taking a 9.9% stake in the bank for $705 million. The question then becomes, so you have a flurry of deals and more to follow, I'm sure. Okay, once it's like a domino effect. Once starts, it's going to be a flurry of deals. Make no mistake about it. But the question then becomes, why now? Why is the banking sector suddenly getting so much foreign interest? Or rather, why is the Indian banking sector suddenly getting so much foreign interest? Basically, all these investments make one thing clear to me. India's growth prospects are very real and not something that people assume, because the banking sector is what I call the heart of whatever economic growth, or, if the banking sector is not doing well, forget about any economic growth. I don't care what data is doing. The banking sector is strong and it's really doing well, then the economic growth story is real. And that's exactly what I mean by growth prospects are real, not something that people assume. The Indian economy is the fastest growing major economy, supported by expanding consumption, urbanization, and rapid digital adoption. Formal credit is also soaring across retail, housing, and small businesses, but India continues to remain underbanked, with large segments depending on informal sources, which then makes it a major opportunity for foreign investors. By acquiring stakes in established banks and NBFCs, foreign investors quickly gain regulatory footholds, customer bases, and broad distribution networks, accelerating scale and market entry. Now, the digital infrastructure of India is second to none in my view. It has evolved and grown so much that it has revolutionized transactions and financial access to such an extent that other countries are actually using it as a model today to build their own digital platforms, to build their own digital ambitions. And digital payments now dominate India's transaction landscape, accounting for 99.8% of all payment transactions by volume in the first half of 2025, according to a very recent RBI report. During the first half of 2025, total payment transaction value reached 1,572 lakh crores. Do the math, do how many zeros are there, you'll see what I'm talking about, of which digital methods accounted for 1,536 lakh crores. It's a striking transformation, ladies and gentlemen, as digital payments have absolutely rapidly outpaced traditional modes. Over the last decade, digital transactions in India increased 38 times in volume and more than 3x in value. The CAGR, CAGR from 2014 to 2024 was 52.5% and 13% in value. For the past 5 years, CAGR was 46% in volume and 10% in value. The digital readiness of the sector makes India's banking future particularly attractive for global entities seeking scalable, tech-driven financial models. And who knows how much this is going to explode once AI really gets into that, into its next phase. Who knows how much the digital transaction is gonna explode. You'll have, it's going to completely, in my opinion, it's going to completely transform the banking sector as far as I'm concerned. It's already doing it. When you add the AI catalyst, oh my, it's going to be so. It's only fair that global entities are now picking up stakes right now, and you can see why there's so much interest. The Indian banking sector has also come a long way since it was facing constant periods of significant distress. Up until a decade ago, there were a lot of bad loans and defaults, aggravated by crisis at firms like IL&FS and DHFL. Since then, regulatory reforms, tighter supervision, and widespread balance sheet repair have dramatically improved resilience. Today, Indian banks are well capitalized, transparent, and better able to absorb credit costs. S&P Global Ratings say Indian banks are well placed to weather global uncertainties, expecting pre-provision operating profits at 3.6% to 3.7% of the loans, and projecting credit growth of 11.5 to 12.5 over FY26 and FY27. Although unsecured retail, SME, and microfinance segments could see higher stress and new NPA formation at 1.7 to 1.8%, banks in general are expected to manage these risks quite effectively. Finally, investors have to acknowledge that amid global economic and geopolitical uncertainty are two themes that I've talked about week in, week out on the show. India's domestic focus and low global market correlation positions it as a stable, attractive destination for capital. Investors view India as a low-risk gateway for alpha generation in emerging markets due to its relative insulation from global turmoil. Recent deals show that years of efforts cleaning up the Indian banks are now starting to pay off. India's growth goes through the banking sector, as I said at the start of the segment, and given that the strong growth prospects, global giants now view the banking sector as an attractive investment opportunity. By acquiring stakes, they're also gaining a direct exposure to the revolutionary development, which is India's digital infrastructure. And what's more interesting for Indian investors, ladies and gentlemen, especially in the banking space, is that they can expect more such deals to come. And this is because there are talks of the Indian government passing a reform to raise FDI in state-run banks from 20%. The cap is currently at 20%. It's expected to be raised to 49%, aiming to attract more overseas capital and narrow the regulatory gap between public sector and private sector gap. Remember, private sector can go up to 74 today. Public sector is 20, so 49% makes sense. I mean, it's a much needed reform, in my opinion, as it would allow them to raise much needed capital in response to increasing credit demand and India's robust economic growth, which has averaged 8% over the past 3 fiscal years. The reform targets India's 12 government-owned banks, which collectively hold assets of 171 trillion rupees, and that's almost $1.95 trillion, and account for 55% of the country's overall banking sector. Remember, public banks continue to be the significant driver for overall India's economic growth. Should deals start flowing through to the state-run banks as well, then it would signal a massive growth opportunity for the entire sector going forward. It would take time for all of this to materialize, but the fact that a flurry of deals have already happened, and certainly more to follow, the Indian banking sector, in my view, is well positioned, more importantly, well capitalized to contribute to India's growth story more so than before. Certainly a space for investors to consider, certainly a space for investors to look to invest in my opinion. And on that note, let's head now to the final segment, Dr. Dissects, where you'll see me just go back for 30 seconds while I pick the notebook and the pen and for when we discuss the valuation. And I'm back. It didn't take less than 30 seconds. Right. From last week was AI names. This week, we're going to switch to industrial giants. And the company that's going under the microscope is FedEx Corp, ticker FDX. And you would recall, this is a company that I've never been a fan of. It's been 2 sell ratings. Am I going for a hat trick? Let's find out. FedEx reported its Q1 earnings last month, and it was a very strong report with a beat on both the top and bottom line estimates. More specifically, Q1 revenues came in at $22.2 billion, up 3.1% year over year, and beating analyst estimates by $591.1 million. Non-GAAP diluted EPS came in at $3.83, up 6.4% year over year, and beating analyst estimates by 22 cents. Non-GAAP operating margins returned to expansion mode after declining in the previous quarter, albeit marginally, expanding by 20 basis points and coming in at 5.8%. As evidence of management having more visibility heading into the year, the company did provide clear-cut guidance for FY26 this time, as opposed to Q4, when it reported Q4 results, when the company announced that it would not be providing any guidance due to a highly uncertain macro environment. Wonder what's changed now. More specifically, the company now expects FY26 revenues to grow in the range between 4% and 6%. Non-GAAP diluted EPS is now expected to come in between $17.20 and $19, with the midpoint that would be $18.10, implying that full year EPS would be flat on a year-over-year basis. Now, FedEx, let's move on to the takeaway. Those were the numbers. We always discuss the takeaways as well, right? FedEx may have top expectations, but I don't see any major structural shifts, either in the business or in the macro environment, to be excited about the company's long-term prospects. I'm sorry, I just don't see it. For instance, one of the key takeaways from FedEx first quarter was the improvement seen in the average daily volumes of its US business. But this improvement can be predominantly seen only on a sequential basis, as seen from a massive jump from a negative 6.7% quarter-over-quarter growth in Q4 to 0.7% plus 0.7% quarter-over-quarter growth in Q1. On a year-over-year basis, he attempts to say that the growth in US average daily package volumes, or ADV, actually declined from 5.8% year-over-year in Q4 to 4.7% year-over-year in Q1. It's all about perspective. It's all about data. Selective data doesn't get you anywhere. As such, I'm not entirely sure what the whole excitement from the management was with respect to the US ADV for the quarter in their earnings call. When one looks at international ADV, then the picture becomes even more bleak. From registering a 2.7% year-over-year growth in Q4, the year-over-year growth in Q1 has sharply declined to minus 3%. On a sequential basis, the change has actually gone from minus 2.3% quarter-over-quarter to minus 3.1% quarter-over-quarter. Therefore, while management during the earnings call patted themselves in the back, don't know why, they keep doing that, for capturing demand from Southeast Asia and Europe to offset the decline seen in China due to an end of the de minimis exemption, investors should certainly take the news with a grain of salt. In fact, add multiple grains of salt, I would say, because FedEx management has a track record of this. Overall, when one looks at the ADV picture holistically, the so-called gains achieved by the company are hardly a needle mover, in my opinion. Now, this is not to say the company didn't make any progress in the quarter. I would be a complete cynic. I would be complete negative. I would be completely biased if that was the case. The revenue growth seen in the FedEx Express segment, 4.4% year-over-year in Q1 compared to 1% year-over-year in Q4, as well as the $200 million in savings made via Drive 2.0 and Network 2.0 are certainly impressive in my view. However, even within these elements, there are reasons for investors to be wary. For instance, when a company's management says that a cost-cutting program has become fundamental to how we run our business, investors should certainly be cautious, in my opinion. Any company that considers cost-cutting as a fundamental driver of EPS growth instead of actually focusing on improving its top-line growth is one whose long-term prospects don't appear very promising to me. Moreover, the company back in July announced there would be a 5.9% increase in demand surcharges. The impact of this, along with the overall inflationary impact of tariffs, makes it unlikely for FedEx Express to maintain this revenue growth improvement in the coming quarters, at least based on my analysis. Overall, while there are pockets of incremental improvements seen in the FedEx business, on a holistic basis, there has not been any significant progress made by the company. The only thing that has remained constant is management's over-optimism. not even going to call it overconfidence, but give them cut them some slack, but I'm still going to say it's just over optimistic. All right, guys. Notebook ready, pen ready. That can only mean one thing. We value FedEx, right? We value FedEx. As mentioned earlier, the company now expects FY26 non-GAAP diluted EPS to be between 17.20 and 19. Management has mentioned that the midpoint of the guide 18.10 assumes a revenue $18.10, assumes a revenue growth of 5% and $1 billion in savings from both Drive 2.0 and Network 2.0. For a company to hit a revenue growth of 5%, it would imply that the growth seen in the US domestic segment in Q1 continues for the rest of the year, and the headwinds of the international business stabilize to current levels. At the same time, the company announced that there would be $1 billion of revenue headwinds. Then there is the fact that although domestic parcel volumes are expected to grow at a 4% CAGR over the next 3 years, the likes of Amazon and Walmart are expected to take market share away from the likes of UPS and FedEx. When one combines all these factors, I don't see a path where the company maintains an overall revenue growth of 5% for FY26. As such, I do believe that they're overly ambitious targets from FedEx. Therefore, I have assumed FY26 EPS to be $17.20, lower than my previous estimate of $18.87. Okay, so FY26 EPS is $17.20. Okay, $17.20. Now, company, according to Seeking Alpha, currently trades at forward price to earnings of 13.29, in line with its 5-year average of 13.42. So fair enough. So we go for price to earnings multiple is 13.29x. Okay. The company currently trades at a forward PEG ratio, which is price to earnings to growth ratio of 1.11, very much in line with its 5-year average, just above, but well below the sector median of 1.84. So what I've done is 1.84, 1.11, and then 1.10. I've now then calculated the projected FY27 EPS based on these 3 PEG ratios. So you have, but the price to earnings multiple remains the same across all 3 scenarios. And so that's PEG, that's PE, and that's EPS. And then basically the EPS for FY26 estimate also remains the same across all 3 scenarios. So you have the 3 pegs, and then everything else remains the same. So what has happened is the projected, the forward. So I told you the PE remains the same. EPS for FY26 remains the same. Now, according to Alpha Spread, FDX is a cost of equity of 7.42%. FDX is a cost of equity of 7.42%. So when you apply this as a discount rate, and then you basically calculate the projected EPS based on all these 3 for all 3 scenarios, get the average, and get the and then discount it back, the present value of FY27 EPS comes out to be $17.37. Projected FY27 EPS, present value of the projected FY27 EPS comes at $17.37. So $17.37. So you take 13.29, multiply that by 17.37, and you get a price target of 235, which is about 4% overvalued, which shows that the stock is about 4% overvalued at current levels. When you've got 4.5% overvalued at current levels, you don't really short the stock. You can also at the same time, the stock short-term momentum is actually C+, which is again weak, but it was C- about a month back. Now it's gone up C+, so the slowly momentum is building up. While momentum is remaining weak, it is slowly building up. So when you take things together, you have limited downside, slowly building momentum. I'm not going to give a sell rating, but I am going to put a hold rating on FedEx. So my rating is a hold with a price target of 235, which, although it's an upgrade from sell, it still implies new investors stay away from the name, still implies old investors to trim profits. Wouldn't recommend a short, but you don't want to exit the whole position, that's fine, but at least profit taking is warranted in my opinion. Bottom line, FDX had a very strong start to the year. Beat on both the top and bottom lines. Management even provided a clear-cut guidance for FY26 with a number of caveats attached to it. Don't really like that. I don't even know why they gave the guidance if you've got bazillion caveats. While the FedEx Express segment certainly showed meaningful improvement in terms of revenue growth, Overall, the story remains the same, which is that FedEx continues to be a company operating in a challenging macro environment. While the company cited improvements in US domestic volumes, growth on a year-over-year basis came in much worse compared to the previous quarter. International volumes continue to feel the heat from a multitude of factors, especially the ending of the de minimis exemption. On a valuation basis, story remains the same, which is that the stock remains overvalued at current levels and momentum remains weak. Building up still remains weak though. While I have upgraded from sell to hold, I still wouldn't recommend the name to new investors. And given the macro backdrop and all the caveats attached to the guidance, I would certainly be taking some profits if I was an existing FDX investor, which I am not. FedEx management certainly deserves credit this quarter for the relatively strong growth seen in FedEx Express, as well as for their cost-saving efforts. However, from a long-term perspective, they still continue to live in denial and now see cost-cutting initiatives as a fundamental way of running the business. That last part, cost-cutting initiatives, fundamental way of running the business, that last part in itself should make investors wary to stick with this company. That's all I have the time for you this week. If you have a specific Indian or US stock suggestion for the doctor to diagnose and dissect, do tweet me at Uttamvinay, UTHAMVINAY, or email me on thestockdoctorpodcast@gmail.com. Thank you once again for listening. I will see you next week, same time, same place. Until then, stay safe and make some money.